Hello traders, Gary Wagner here. It is 11:55 in Honolulu, 5:55 in New York on Monday, 26th day of September 2022, and this is the daily report for gold and silver. As I explained in our opening letter, which is really part 2 of the opening letter on Friday, it is the lack of a quick and timely response by the Federal Reserve that has led us to where we are now, which is spiraling inflation, and the fact that the Federal Reserve has done too little, too late, and it will lead us into a deep and protracted recession. Gold is down by $26.30, with its December contract currently fixed at $1,629.30. It's a combination of selling pressure in the market as well as dollar strength. The dollar once again gained a full percentage point, 1.02, and is currently fixed at 114.11. Silver declined by a massive 3%, with the December contract down over 57 cents and is currently fixed at $84.34. The fact that we have had major chart damage in gold and that the dollar continues to grow in strength when compared to other currencies absolutely tells us that we have hit an inflection point. If you recall from my opening letter on Friday, as well as part 2 today, the Federal Reserve has made such a tremendous misstep that my sense is that in order to bring inflationary pressures to an acceptable level, some dramatic and drastic actions have to be taken in terms of raising interest rates. Currently, the Federal Reserve is expecting to raise rates to approximately 4% by the end of the year. But as I explained on Friday's show, as well as detailed in our opening letter, that is not enough. To deal with an inflationary level of 8%, we have to take interest rates to at least 8% in order to bring it down to an acceptable level. Clearly, that has not been done, and if the Fed does enact that, it most certainly will lead us to a tremendously deep and long recession. We're looking at a dollar chart, and on this dollar chart, what I've done is shown the area in which the dollar was at during the 80s when we had the highest level of inflation on record at 14.5%. Based on a Fibonacci extension in which we begin at 79 up to 121 and then start at this low here at 71, our first level that we could see the dollar index go to is 123. Realize that's very close to 121 or this former high. We might see the dollar even move higher, somewhere between 121 and 127, possibly 124, 125. During that time, we will most certainly see gold trade lower, which means that we have to address our trading style and begin to short the market rather than look for dips in the market, in that it is highly unlikely that gold will find support and move into any rally that is sizable and tangible. We are looking at a weekly chart of gold futures, and on this chart I have added a Fibonacci retracement. This retracement starts back at about July, when gold was trading at 1170 up to the record high. And as you can see, we've had that line in the sand, that key and critical area that I've spoken about at approximately 1780, and that was breached last week. We have follow through this week, which means that if they continue to raise interest rates to a level in which it will affect inflation, it will take the dollar higher. For U.S. debt instruments, will move much higher, and that, of course, will move gold lower. The first place that we could look is 1632. That is the 50% retracement. However, I believe that we could see gold break through 1600 and trade as low as 1523. That is the 61.8% fib retracement, or it could go somewhere in between that price point. The problem that we're going to face now is that the Federal Reserve has acted too little, too late. They are playing catch up, and we will see gold, in my opinion, move lower, substantially lower. And that's why I said it will entail to make money to short gold rather than to go long gold. That is the only reasonable course of action I see. At the end of this short video here, I'm going to include an excerpt from Friday's show so that you can see once again how serious the situation is, in that the Federal Reserve reacted so very slowly, much too late, with very little action in terms of raising rates to an appropriate amount. On today's weekend review, I want to have a different approach. Take a look back in history to how different members of the Federal Reserve handled high levels of inflation and brought them back to acceptable levels, how the dollar reacted at this point, and most importantly, the focus on our opening letter, and that is the one critical mistake that the Federal Reserve made by acting too late and believing that inflation was transitory, and really sat back as they watched inflation ratchet up in 2021. This is not the first occasion when the United States had the problem of addressing exceedingly high inflation. In fact, the highest level of inflation on record occurred at the end of the 70s and into the 80s. You can see that on this consumer price index. And by 1980, we saw inflation move from 6% up to 14% vis-a-vis the CPI. I have just put up not only the inflation index table, but how the Fed addressed it by raising rates. What we are looking at in this graph is both the real interest rates and inflation, with inflation coming in is a dashed line, that is this line right here, and the rate of interest rates rising as a solid line. You can see a very, very close correlation. As inflation rose to over 5%, the Federal Reserve addressed it by raising interest rates to approximately 5%. When we had our first real peak, the Fed was a little bit slow to act, but they slowly moved. And as we had this hard spike right around 78 to 1980, when inflation hit the highest level in history, just at about 14%, real interest rates were well above that. That being said, it was a multi-year process to take interest rates and inflation to acceptable levels. In other words, it was a multi-year process. When we look at inflation, and this is the average inflation of 79, that was 11.3%, then 13.5% in 80. Realize they are raising interest rates as this is occurring. In 1981, we went from only 13.5% to 10.3%, by 82 to 6.2%, and it wasn't until 1982 when the Federal Reserve, through aggressive rate hikes in a timely manner, brought inflation to a respectable level at 3.2%. In contrast to how we saw the Federal Reserve reduce inflation at a record 14% in the 80s, we are looking at a 12-month inflation rate beginning in January of 2020, going up to August 2022. The pandemic was in full swing in 1919 and really throughout the 1920s. But in January of 2021, we had a real interest rate that was still rather low. It was below 1.5%. By February and March, it was starting to rise. And by March of last year was approaching 2%. Because the Federal Reserve believed it was transitory, they did nothing. A month later, it went to 2.6. The Federal Reserve did nothing. 4.2%, 5%. In fact, by the time the Federal Reserve actually enacted its first rate hike, which is here in March of this year, inflation was already at an astounding 7.5%. Now, it is a known fact that historically speaking, you cannot reduce a level of inflation without matching interest rates to the current rate of inflation. The Fed has raised rates from near zero in March to its current rate of 3.5%. And 3.5% is a level in which it is not going to have any impact on inflation that is currently at 8.3%. In other words, what I'm trying to show is that the root cause of not only the level of inflation now, but the upcoming inevitable recession, which I believe will be deep and protracted, is because the Federal Reserve acted too late, because they incorrectly assumed and acted upon the assumption that inflationary pressures were transitory. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.